So we are told there part B, Softlex Limited is contemplating building a 3 assets portfolio comprising assets of firms A, B, and C. So 3 firms, 1 portfolio. The company wishes to invest $5 million in the shares of these firms. Given below are the number of shares and the current market prices per share for each. So these guys have given me company A, you are able to see number of shares there. You are able to see current market price per share. Current market price per share. The forecasted market price for each share after 1 year and the probability of occurrence in different states of nature are given as follows. It's question number 1B. So, ladies and gentlemen, could you kindly advise me, when you see number of shares and you are able to see market price per share, what comes to your mind very fast? September 2021. September 2021. Question number 1B. September 2021, question number 1B. So when you see number of shares and then you see market price, isn't it? You multiply them, isn't it? You give us the total market value. So we have here question number 1, September 2021, question number 1. So first of all, we have here 3 companies, ABC. We have here the notes, the number of shares, and then we have the market price per share. So here we have 50,000. Here we have 32,500. Here we have 40,000. And then market price per share, here 50, 40, 30, 50, 40, 30. So could you kindly give us the total value here? The total value will be the number of ordinary shares times the market price per share, times the market price per share, times the market price per share. Could you kindly give me those numbers very fast? I would want us to capture them in shillings, thousands. Please cut 3 zeros, cut 3 zeros, cut 3 zeros. You guys are very tired. Be yourselves. Be the good people that you have always been, very supportive. Anyaki tells me 2,500, right? How about 32,500 times 40? 25, 1,400, Abdi, thank you very much. And then lastly, what do we have here? 4,000 times 30? 1,300. 1,300, okay, 1,300. And then this is 1,200. Please give me the total. Please give me the total. Please give me the total. When you add here the total, what do we have? Somebody there. Total, what do we have there? Somebody. We have 5,000. So out of this, we shall be able to get the weights, isn't it? If it's a portfolio, if these are the investments in our various securities, then we shall easily get the weights. So this will be 2,500 divided by 5,000. This will be 1,300 divided by 5,000. This will be 1,200 divided by 5,000, like that. Like that. So 2 decimal places, please give me the figures. 2 decimal places, give me the figures. I can see my friend Kelvin Muturi. Claire gives me 0.5. 0.5 there. Then we have the next one is 0.26 mesh keep. Then the next one should be 0.24. 0.24. Thank you very much. At least they've been able to get low-hanging fruits. Now, after that, look at what they have done there. The forecasted market price for each share after 1 year and their probability of occurrence in different states of nature are given below. So I can see state of nature, boom, normal, recession. I can see forecasted share price, forecasted share price, forecasted share price. So ladies and gentlemen, then, what am I supposed to do? I hope I can rub this. Can I rub this very fast? Can I rub this? Can I rub this? Yes. Yes. Great. So, ladies and gentlemen, I can see right away that these guys have given me my state of nature. So we have here state of nature. We have their state of nature. So state of nature, we have boom, we have normal, we have recession. Recession. So then I would want you guys to give me, returns of A in form of percentage. Returns of A in form of percentage. If we have boom, A will give me 60. A will give me 60 bob. A will give me 60 bob. But remember up there, A's current price is 50. Is there somebody who is able to see A's up there from the table up there? Is there somebody who is able to see A's current price is 50? I'm alone, but I'll overcome. So 60 minus 50 divided by 50 times 100. This was quite a rare question, right? So I'm trying to get the percentage increase in price. The percentage increase in price, right? Just like, for example, you could be told that the current of price of sugar today is 50, right? Or petrol. Petrol, for example, sometime back, it was is it 105, right? Right. And then after some time, ladies and gentlemen, we are told here petrol is going for about what? I don't know the price. I don't buy petrol, right? So 105, 140. So what is the increase in price? What is the increase in price? What is the increase in price? What is the increase in price here in terms of percentage? So you'll take the difference. You know, this is the original. This is the new price. So it will be 140 minus 105 divided by the old 105 times 100, isn't it? Times 100. Yeah. So are we together there? So like this one here will be 60 minus 50 divided by 50. Whatever we get, we say times 100. So they're telling me it's 20%, right? Is that okay? What if in this case here for A, the state there will be normal? So if it's normal state, the price, new price there will be 55. Our old price, of course, for A doesn't change, 50, divided by the old price of A, which is 50 times 100. Could you kindly give me a figure there? 10. How about in this case here, recession? Recession, the price under recession is 48. So it will be 48, it will be 48 minus the original price of A. Please don't fluctuate, don't go to B. We are not yet in B. We are still in A, whose current original price was 50 divided by 50 times 100. So could you kindly give me this last one? Could you kindly give me this last one? Claire gives me minus 4%. Remember, I'm not writing the percentages here because I have it up here. I have it up there. So great. So then could you kindly go ahead and give me the returns of B in form of percentages very fast? Without doing much write-ups. Is there somebody who can give me the returns of boy? What is the original? What is the original current price of boy? What is the benchmark price of boy? 40, thank you very much. Now, out of 40, I should be able to get the price increases in the form of what here? Percentages. In form of percentages. So in form of percentages, very fast. Is there somebody who can talk to me tonight? Abdul Naji tells me this is 25. Tells me this is 25. 25, 25, 25. Yes. How have they done that? They've taken here B and a boom. B and a boom is 50 minus the original, which you guys gave me 40. Original price, you gave me 40. So 40 divided by the original 40 times 100 times 100, which people are giving me a figure of 25. Next one I'm being told is 15. The last one, Ningapi, somebody? The last one. The last one, Ningapi, somebody, the last one. The last one, Ningapi. The last one, Ningapi, minus 12.5. Thank you so much. So how about the very last one, C now? Returns of C in form of percentage. Returns of C in form of percentage. Returns of C in form of percentage. So wananiambia hii ni 20. Thank you very much. Next. 13.3%. Lastly, what do we have there? Lastly, somebody? Minus 10. Minus 10. Now, ladies and gentlemen, after I reach there, I would want you guys to do me a favor. Please remember, we already have our probabilities. Probability of boom is 0.3. Probability of normal is 0.4. Probability of recession is 0.3. Now, having gotten this particular metrics, these particular probabilities, versus the returns, a good student will tell you the next thing should be for you to get expected returns. So could you kindly give me expected returns of A? What do you think shall we do to be able to get expected returns of A? What shall we do to be able to get expected returns of A? It's tata, isn't it? You take, like, these are the returns of A up to here. So you multiply them with their corresponding probabilities. So we have here 20 times 0.3 plus 10 times 0.4 plus minus 4 times 0.3. Could you kindly give me the expected return of A? We multiply, yes. Yes. Please give me the expected return of A. Give me the expected return of A very fast. Don't have time today, really. All right. All right. All right. So Anyaki tells me it is 8.8. Anyaki tells me returns of A expected is 8.8. Then go ahead and give us expected returns of boy. This is very important. Expected returns of boy, I can see the actual returns of boy, they're here. So please multiply them with the probabilities. So we have 25 times 0.3 plus 15 times 0.4 plus minus 12.5 times 0.3. What figure are we getting there, somebody? 2.8, eh? Silvanus is telling me that the second last should be 2.8. Should be 2.8. Abdul tells me this is 9.75. There is a student who is telling me that, Mwalimu, you know what? This 8.8 is wrong. The 8.8, is it correct or wrong for A? The 8.8, is it correct or wrong? Is it correct or wrong? Is it correct or wrong? They are saying it's supposed to be 11 point. Please remember that this is minus 4. Remember that this is minus 4. It's minus 4. So it's correct. How about expected returns of boy, 9.75? 9.75, is it correct? 9.75, is this correct? For boy? Yes. Then we go to expected returns of cow. Expected returns of cow, what do we have there? We have 20 times 0.3 plus 13.3 times 0.4 plus minus 10 times 0.3. Please give me a figure. Give me a figure, 8.32. No, Mayom will be able to catch up, Mayom. Don't panic. Don't panic. Don't panic. It's September 2021, question 1B. September 2021, question number 1B. So the last one we have there is 8.32. But now remember, this is not what the examiner wanted you to provide. What the examiner wanted you to provide is a combination. The examiner wanted you to get expected returns of the portfolio. Expected returns of the portfolio. So how do we get expected returns of the portfolio? We shall take weight of A, expected returns of A, plus weight of B, expected returns of B, plus weight of C, expected returns of C, like that. All right. So then could you kindly go ahead and plug in? I know you already have the weight. Is there somebody who can remind us the weight of A? Is there somebody who can remind us the weight of A? Adjust the board. Is there somebody who can remind us the weight of A? The weight of A. The weight of A. Are you able to remember the weight of A? The weight of A. I hope that is better. So the weight of A, I'm being told, is 0.5. expected return of A, I can see here it's 8.8, right? Plus weight of B, 0.25 times the expected return of B, which is 9.75, plus weight of C is 0.24, right? 0.24. So this must have been 0.26. So 0.24 times 8.32. Could you kindly give me this expected return of the portfolio? Give me the expected return of this portfolio. Give me the expected return of this portfolio. 8.93. So Rebecca and Mayom, I would suggest that you watch the video. Sorry, I'll expect you guys to watch the video immediately after this. After all, from where we are, you guys will be able to pick. Yes. So ladies and gentlemen, if you go to the next question there, they want us to give them, we compute the portfolio risk. So how do we compute the portfolio risk? Mayom wants me to allow him to summarize. Perhaps you take a video, not a video, but like a snapshot, a photo. Yeah, portfolio. So first of all, we get what here? The standard deviations, yes. We get the standard deviations. So let's get the standard deviation of A. Let's get the standard deviation of A. Let's get the standard deviation of A. Please allow Mwalimu to delete this, to grab this, Mayom. Time not on our side, because we have quite a lot of theories to discuss. So then I would want us to get the expected, or rather the standard deviation of A. Is there somebody who can remind me the formula? Standard deviation of A equals, so we are talking over the actual returns of A minus expected returns of A, like that. And then these have to be squared times probabilities. And then of course we have the sum. And then at the end of the day, square root like that. So we have the actual returns of A, they are here in form of, so 2010 minus 4. 2010 minus 4. So minus. Are you able to remind ourselves, are you able to remind us what the figure of expected return of A was? Expected return of A ilikuwa ngapi, somebody? 8.8. So expected return itakuwa the same throughout. 8.8, 8.8, 8.8, like that. And then we do what here, somebody? We square times probabilities. These are the probabilities. We have 0.3, 0.4, we have 0.3, like that. Equals. What do we have there, somebody? Please remember that this square root comes after what here? After summation. The square root comes after summation. The square root comes after summation. Don't go giving a square root of each one of them. No. Could you kindly give me the value of the first one? 37.62. 37.62. The value of the second one? The value of the second one. This lady called Sue is very aggressive. She should get a present from me. Right? 37.62 or 63. So I believe the second one should be 0.58, right? 63. One and the same, really. 63. Mesh keep 0.63 confirmed. So the last one now, 49.15. So then could you kindly give me the total now? Please give me the total when you add the 3. Please give me the total. So somebody can give me the total very fast. $87.36. So this is 87.36, and therefore standard deviation of A will be the square root of 87.36, which will be equal to what, somebody? 9.35. Thank you very much. So could you kindly go ahead and give me the standard deviation of B now yourselves? Please go ahead and give me the standard deviation of boy. Very fast. Please run with speed. Give me the standard deviation of boy. Remember, the probabilities are the same. 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 So I'm now waiting from you. I'm waiting to get the standard deviation of who? Boy. Okay, standard deviation of boy. So I'll write down the formula. The standard deviation of boy, I know these will be equal to the actual returns of boy minus expected returns of boy, right? So square times probability, summation there, and then I say square root. So the actual returns of boy, we have 25, 15, minus 12.5, minus. How about expected returns of boy? Expected returns of boy, you guys can remember the figure. Expected returns of boy, that one is a uniform figure which doesn't keep on dancing, which will be the same throughout, So 9.75. So 9.75, 9.75, 9.75. And then, ladies and gentlemen, you will come and do what here? You square times probabilities. So probabilities, we had 0.3, 0.4, if I'm not wrong. So then I'll be able to come here and ascertain the equals. So Anyaki gives me 15.14. Thank you very much, Anyaki. Thank you very much, Anyaki. Silvanus already Silvanus has the standard deviation of boy as 10.89. Silvanus, can you kindly give me these other figures? 11.03. The last one. The last figure, Mugema kimsifu kweli anatia tembo maji. Nilisema sio ananipatia figure haraka alienda kanyamaza. 15.14 ni standard deviation. Okay. So naambia kwamba 15.14 ni standard deviation. 15.14 is standard deviation. So then how about this for the students who are doing this? For the students who are trying to get these figures, is there somebody who can give me this very fast? Please give me this 69.77. Thank you very much. How about the second one? 11.03 approximately. The last one, 148.52. 148.52. So total 229.32. It's upon taking the square root of this 229.32 square root. That's how we were able to get that 15.14. Now the standard deviation of C, ladies and gentlemen, now I expect you guys to give me the answer directly. Standard deviation of C. Which question? September 2021. Question number 1, boy. September 2021. Question number 1, boy. September 2021, question number 1, boy. September 2021, question number 1, boy. Question number 1, boy. Great. So is there somebody who has been able to give us the standard deviation of C? Is there somebody who has been able to give us the standard deviation of C? Is there somebody who can give us the standard deviation of C? Please, standard deviation of C. I'm so sure now you guys will be able to follow the methodology that I've just shown you to get the standard deviation of cow. To get the standard deviation of cow, is there somebody who has that figure somewhere? 12.31. 12.31. But now, ladies and gentlemen, remember, what they want us to do, of course, we've been able to get the security risks, the security standard deviations. But you see, they want us to give them the standard deviation of the portfolio. To get standard deviation of the portfolio, I need what we call covariances. But this crazy examiner went ahead and they gave me coefficient of correlations. You can see them down there. So then how do we change coefficient of correlations to covariances. Is there somebody who knows a formula which can help us to change correlation coefficient to covariance? Is there anybody who knows a formula? Is there anybody who knows a formula? Is there anybody who knows a formula? Yes. Alice Muthia. Cubrut, uongo. Juliana, uongo. You see, what you're supposed to know here is that when they give us correlation of AB, correlation is the standardized covariance. It is the standardized what here? Covariance. Yeah. Correlation coefficient is the standardized covariance, meaning you should take the covariances, you divide them by their respective what here? Standard deviations. And therefore, to get covariance between AB, you will take R between AB multiplied by standard what here? Deviation A, standard deviation B. I've only taken this the other side like that. So could you then kindly give me the covariance between AB there? So covariance between AB, I can see the correlation. It's 0.98. Do you guys remember the standard deviation of A? Do you guys remember the standard deviation of A? Do you guys remember the standard deviation of A? 9.35. Thank you very much. How about the standard deviation of boy? How about the standard deviation of boy? The standard deviation of boy, 15.14. Thank you so much. So then could you kindly give me this covariance between A and B? Please give me this covariance between A and B. $138.7, 138.75, like that, 138.73, sorry, 0.73. Thank you very much. Thank you very much. So next I can see there is another pair there, covariance between A and C. Covariance between A and C, covariance between A and C. So I'll take the correlation between AC multiplied by the respective what here? Standard deviation. So the correlation between AC, this will be 0.76 times the standard deviation of A that you guys gave me as 9.35. However, I do not know what the standard deviation of C is. I don't know what the standard deviation of C is. I don't know. 12.31. Thank you so much. Thank you so much. So then could you kindly give me this covariance between A and C? $87.47. 87.47. Great. So the last one is covariance BC. Covariance BC, I'll just take it direct. I'll take +1 there times the standard deviation of A, the standard deviation of B, standard deviation of B that you guys gave me somewhere. There's a standard deviation of B here, 15.14 times standard deviation of C, which I've forgotten. Standard deviation of C that I've forgotten. What is the standard deviation of C, somebody? 12.31. Thank you so much. So then ultimately, what shall we get as the covariance of boy and cow? 186.37. 186.37. Thank you. And thank you so much. Now, ladies and gentlemen, I would want to see whether there is any student here who now will be able to write the big formula. Will be able to write the big formula of standard deviation of a portfolio. The biggest formula of standard deviation of a portfolio that has got 3 securities. This is so big. This is so big. It's so big. It's so big. It's so big. It's so big. This is so big. Andika 2, Karosi andiki. Is there somebody who knows? Yeah, 3. Kumbuka, these are 3 securities. Normally, Actually, this is the only time we had this examiner giving us 3 securities. In all other scenarios, they give us how many securities? 2. Is there anybody who can try giving us a formula of getting the standard deviation of a portfolio for 3? Mesh, cram tu isi ngumu sana. Hiyo utashikanisha. Sababu, ikiwa ni standard deviation of a portfolio that has got 3 or what's up, 3 securities, A, B, C. No worries. I'll come and talk of weight A, standard deviation A, plus weight B, standard deviation B, plus weight C, standard deviation C, like that. I square everything. Now plus 2 covariance, the first pair. Remember here we have 3 pairs. Here we have 3 pairs. Which pairs do we have? We have pair AB, we have pair AC, A and C, and then you can this is like salivation. Salivation is backward, or rather, yes, backward never, forward always. It's always forward, right? So you can say BA. So you say AB, AC, AB, AC, and then now B what here? BC, BC like that, right? And then, ladies and gentlemen, now you'll come and add the word covariance here. Add covariance like that, right? So we pick this as the first pair. So twice covariance, AB, weight A, weight B, plus twice. I go for the second pair. Twice covariance, AC, weight A, weight C, right? Plus, for lack of space, I'll come and fix the last pair here. Plus twice covariance, BC, weight B, weight C, like that. And then at the end of the day, there must be a very big square root. At the end of the day, there must be a very big square. Don't forget this plus here, please. It's supposed to be a continuation. Aha. So could you kindly remind Mwalimu the weights here very fast? Is there anybody who is able to remind Mwalimu the weights very fast? The weights? Yeah, you must put the weights always. Weight A, weight B. Weight A, weight C. Weight B, weight C. You must put them. So, ladies and gentlemen, here we have 0.5. Now, for me, I believe where I have reached, you guys now can be able to plug in whatever you will put there, and then you sum everything, and then you give a square root. I believe wherever I've reached, now you guys will be able to pick it up and do what here? Run now with the ball. Run with the ball. Now, ladies and gentlemen, listen and listen to me very well. I would want to wind up this class very fast. Sikuji kuwaweka hapa, nitakwambia kwa nini. Sikuji kuwaweka hapa mimi. Sasa, kuna kitu. Yes. Unakunywa maji mengi kama mimi. Headache inapotea kabisa. Now, ladies and gentlemen, I would want us to do question number 3, just part A, before I tell you what we shall do next. Question number 3, just part A. Roman 1, where they want us to give them expected net present value of the project, and then we ignore the abandonment option, just the first part alone. The first part alone. Position 3. First part alone. XYZ is considering September 2021, question number 3. They are doubting this cannot come. Okay. Yes, Anne. Please type your question, Anne. So XYZ Limited is considering buying a new machine for its manufacturing process at a cost of 10 million. The machine is expected to have a useful life of 2 years with no salvage value. The future net cash flows to be generated in each year are uncertain. The estimated cash flows and the probability of their occurrence are given below. So I don't want to read so much. I can see the cost of capital there is 13%. And then number 1, expected net present value of the project, ignoring the abandonment option. Okay, sorry. September 2021, question number 3. September 2021, you guys don't have this paper. September 2021, question number 3. Question number 3. So remember it's remember it is what here, somebody, it is advanced financial management. You must start with invest. So you're going to invest, make a decision there, invest, don't invest. Don't invest, right? And if we invest, what is going to happen? I can see cash flows that are probabilistic. So by the way, if we invest, what will be the cost? They have told us if we invest, the cost is 10. If we invest, the cost is 10. And if we invest, we can see cash flows in year 1, they are probabilistic. So come and capture them like this. Cash flows year 1. So cash flows year 1, I can see 7, I can see 8, I can see 6 with these probabilities, 0.2, 0.4, and then 0.4 like that. All right. So that's year 1. Those are year 1 cash flows. And then regardless of the cash flow that we get in year 1, regardless of the cash flow that we get in year 1, year 2 cash flows are dependent on year 1 cash flows, you're told. Year 2, now we go to year 2. Year 2. Why am I capturing these things from a probabilistic, a circle, slippery circle? This one here normally is for probabilistic what year events, right? Thank you very much, Baba Q. That one you have already known. So we can see year 2 cash flows, year 2 cash flows, year 2 cash flows. What are they giving us there? Year 2, we could either have what or what. There is a figure which is misplaced. It must be that 7. It's misplaced. So we have 7 there. Actually, there are two at a time. 7 and 6. There are two at a time. 7, 6 with these probabilities of 0.6, 0.4. All right. And then we have 7, 6, 7, 6 with 0.5, 0.5. And then lastly, we have 8, 7, 8, 7, 8, 7. This is 0.3. And then we have point what here? 0.7 like that. 0.7. So ladies and gentlemen, what I'll do very fast here is to come and ascertain the present value interest factor. What is the cost of capital given in the question? What is the cost of capital given in the question? 13%. So 13% year 1, 13% end of year 1. Is there somebody who can give me this figure from your tables? PVIF, 13% end of year 1. Is there somebody who can give me this from your tables? Is there somebody who can give me this figure from your tables? Yeah, 0.8850. So this is 0.8850. 0.8850. How about PVIF? PVIF 13% year 2. PVIF 13% year 2. PVIF 13% year 2. PVIF 13% year 2. What will I get? PVIF 13% year 2. 7831. 7831. Now, ladies and gentlemen, remember, the next thing will be for you to come and give us net present values for each of the branches, ignoring what? Ignoring probabilities. Give us the net present values for each of the branches, ignoring probability. I'll only do one. I'll only do one. So branch number 1. Let me see whether there is anybody who will be able to get NPV of branch number 1 correctly. Let me see whether there is anybody who will be able to get NPV of branch number 1 correctly. NPV of branch number 1. So So how do we get branch number 1 NPV? It's very easy. It's about the Subaru vehicle running all the way from on top of the branch, on top of this route. And then you pick whatever cash flows. So like now we have 7. This 7 has to be discounted. So this 7 has to be discounted. You multiply by year 2, which is 0. Where did I write present value? For year 2. Year 2, you guys, I never computed my PV. PV for year 2, you're going to kuja ngapi? Oye, PV for year 2. PV for year 2, 0.7831. Thank you very much. Kwa hivyo utakuja poseme 7 times 78, 31, plus this other 7 here, like that, times 0.850, plus we have here minus 10. Of course, this cannot be discussed. This is now, like that. Then you should be able to give us the figure. So you'll be able to continue with this, go to branch number 2, branch number 3, etc. up to branch number 5. And then, ladies and gentlemen, now, straight away after get NPVs, I expect you guys to do what here? To go ahead and compute the joint probabilities. I hope from here now you'll be able to finish. I hope from here you'll be able to finish on your own. So ukiona swali ya decision, isikustue sana. Isikustue sana, isikustue sana, isikustue sana, isikustue sana. Great, great. Now, from there, ladies and gentlemen, what I would want us now to do is to look at some theory questions before I advise you. So yet remember what we said. When you are getting net present values, you disregard the probabilities totally. You disregard the probabilities totally, and then later on, you'll come here and put a column for joint what here? Joint probabilities, if you remember. Right? Joint, where you'll come and take all the probabilities along the branch. Like now it will be 0.6 times 0.2. You have this. So you'll be having 2 columns. One column for NPV, the other column for what here? Somebody joint probabilities. And then at the end of the day, you multiply them. You multiply them. Abdul Haji is asking whether we have a video on this, right? Or even Claire never knew this. Claire, we have done this severally. Claire, we have done this severally. We have done this severally. We've done this severally. Great, 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 great. So can I go to something different? Or is there somebody who wants Mwalimu to finish the question? It'll take time for nothing. Yeah, it'll take time for nothing. Great, 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 great. Percentage of sijui. 6 branches. So 1, 2, I skipped 1 year. Sorry, I skipped 1 year. Yes, but at least you guys have an idea. You have an idea. So then give us theory, yes. So to end up straight away kwa theory, katika theory, you don't have to see Mwalimu now. Katika theory, Mwalimu now disappears. Now you'll see Mwalimu's face again when you come for the dinner parties, dinner or breakfast or whichever in Kitengela. So, ladies and gentlemen, your theories in AFM are not as bad as the theories that we have. The theories that we have in AFR. No, ours are straightforward. Ours are straightforward theories. So like the same sitting, September 2021, question number 1. Question number 1A. Question number 1A, modern portfolio theory applies advanced mathematical models to determine the correlation between risk and return of investments. While it is commonly used, it does have some potential drawbacks. In relation to the above statement, examine 6 shortcomings of the modern portfolio theory. Of the modern portfolio theory. So, ladies and gentlemen, are you able to give me those assumptions of portfolio theory very fast? I'll tell you. 1, it assumes no transaction costs. It assumes no transaction cost. So no commissions, no taxes, etc. right? And then number two, ladies and gentlemen, the other one that I'll never forget is that it assumes that all investors are risk averse. All investors are risk averse. They would want to minimize their risks, and that is why they are minimizing, or rather they're going for portfolios, right? Right. It also assumes that investors are rational. They are rational. It assumes that investors are rational. They are rational, meaning that they always make wise decisions, which is not the case. Yeah, it assumes normality. It assumes a normality. Right. Yes, it uses historical data. I like that. It uses historical data, which will, at the end of the day, be converted to expected returns, which may not be realistic. Another assumption, ladies and gentlemen, is the concept of it assumes that a perfect market portfolio exists. A perfect market portfolio exists. That may not be the case. It also assumes a constant risk-free return. Thank you so much, ladies and gentlemen. If you allow me, I'll go to the next question, which is question number one. Question number one. Question number 1C. Question number 1C, September 2021. We're working on September 2021. No, I cannot show the board. I want you to write. I want you to write. No, focus now, Mayom, with the theory. I'll open for you this thing later. Focus on the theories. Focus on the theories, Mayom. Focus on the theories. I'll open this video later. Is that okay? So now we are doing question number 1C. Question number 1C. Question number 1C. Are we there? Somebody, are we there? Explain 4 reasons why derivative instruments have continued to become more popular in financial markets. September. Mayom, we are doing only one paper today. September 2021, the one I've been doing. September. Is there somebody who can share with Mayom this paper on WhatsApp? September 2021. I'll not do very many questions today, many papers today. Somebody please share with him. It is there already. Please pick it, Mayom, and great. So now we are, now we are not going to any other paper, please. So September 2021, question number 1C. Why are derivatives becoming so popular? Even in IFRS, we have IFRS 9. Why is everybody talking about derivatives? Why are they becoming very popular? Could you kindly give me reasons? They facilitate transfer of risk. Yes, risk minimizing, yes, which is the same as hedging of risk. Thank you very much. Yeah, risk management, that's number 1. Number 2, any other reason why do you think are these things becoming very popular? They're cheap. They have lower transaction costs. Yeah. You're right. They improve market efficiency. Yes. They improve market efficiency. Yes. And then lastly is what this, this market efficiency, how does it come, ladies and gentlemen? It's because of what, there are very many players in this derivatives market. If you go to countries that have introduced a derivatives market, in Kenya still, it is at the mooting stage. We have not yet picked. But in countries like Ethiopia, market efficiency for derivatives there is very high, right? Because of the many participants. The concept of supply and what here? Demand. Right? And because of that, ladies and gentlemen, like somebody has told us here, Nancy Yego, underlying asset price determination. Underlying asset price determination. People become so sensitive on the underlying asset price. On the underlying asset price. People become so sensitive. We have the contract paper versus what are we covering. So if you are doing an agricultural commodity derivative, people will be so sensitive with the price of maize. So at the end of the day, then we shall be boya. It's also a business. People go for this because of the profitability, and the flexibility. Remember, derivative market, a derivative financial instrument, you can dispose it anytime you want, right? So you go for it because of profitability and flexibility. Thank you very much. Question number 2 of the same sitting. Question number 2 of the same sitting. Question number 2 of the same sitting. Are we there? Are we there, ladies and gentlemen? Are we there? Great, 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 great. Thank you very much. Great. So you are told here, your country is considering establishing a mortgage refinancing company. It's not mortgage financing, but refinancing. So somebody who has already a primary mortgage that they entered with some bank, and then later on, perhaps they would want to surrender this and go into a more flexible mortgage. So mortgage refinancing to support an affordable housing project for its citizens. Uhuru Kenyatta pillars. 4 pillars. The company's mandate will be to provide secure long-term finance to primary mortgage lenders who will then advance the same to individual borrowers. Primary. In the context of the above statement, identify 3 types of primary mortgage lenders that are likely to benefit from the mortgage refinancing facility in your country. Could you kindly name them? Primary mortgage lenders like Unitas Bank. Unitas Microfinance is a primary mortgage lender, KCB. Yes. So we have number 1 banks. We have a microfinance. We have building societies, isn't it? Building societies. All right. Building societies. You don't have to mention banks, even some SACCOs, these big SACCOs, yes. These big SACCOs, ladies and gentlemen, they have already begun doing properties, houses, buildings there for their members. SACCOs, yes. Yes. Now from there, ladies and gentlemen, we go to part 2 of this. Summarize 3 objectives of a mortgage refinancing company in an economy. Imarisha SACCO is so big, yes. Even Stima SACCO is so big. Right? So I'm waiting to hear from you objectives of mortgage refinancing companies. You can even Google them. They are there. Objectives of my mortgage refinancing companies. Yeah. Provision of long-term mortgage loans at attractive rates. Provision of long-term mortgage loans at attractive rates. I like that. Ladies and gentlemen, Baba 𝐂𝐁 is right because he's telling us the concept of the mortgage cost reduction. Because like Equity Bank, I mean, these guys are not lending their own monies to mortgage owners. They're getting this secondary. They're getting, ladies and gentlemen, they're getting money from mortgage refinancing institutions, both local and international. And because of that concept that, hey, we're getting money here from our big brothers, at the end of the day, they will stabilize. They will make the mortgage markets here at home stabilize at low interest rates. Improvement of standard of living to its members. I like this. Improving standards of living to citizens, because once that cost goes down, now people will be able to afford what? Yeah, homes, right? Yes, there are key components of growing the Kenyan capital markets. Accelerate access to credit, that I'll be able to give you a mark. Yes, yes, that I shall be able to give you a mark. Great. I think, ladies and gentlemen, you have done justice to that. And then Roman 3, ladies and gentlemen, so many students don't understand some of these basic simple things. Many people were unable to do anything here. Highlight 3 minimum requirements that one must fulfill in order to qualify for a mortgage in real estate financing. If you go today asking for a mortgage, I'm very good at this because my property at Isinya and even Kitengela, they're on mortgage. So what are the key requirements, somebody? Pay slip, I like that. So in this case here, the employment history. Because these people would still, at the end of the day, need a proof of steady income. So that is in line with what Moses is telling us, demonstrate ability to repay. People are forgetting down payment. Most of these primary lenders will ask, ladies and gentlemen, for what year? A down payment that you must be having, like say 20% or 30% of the asset what year value. Very few primary lenders will give you 100% mortgage. Very few. Not unless you work for a very stable company like 𝐂𝐅𝐅𝐄, which has been able to give kind of bank guarantees. Right? Ladies and gentlemen, they will ask you for mortgage insurance, isn't it? Mortgage insurance. They'll ask you for mortgage insurance. Is there anybody who can give you mortgage without insurance? Ukikufa je na hii kitu ya 25 years. Ukikufa je, right? And then nowadays, and please, ladies and gentlemen, I always keep on encouraging you and ensure that you don't get into these CRBs. They really mess you up when you will want to go for some of these loans, when you would want to become so senior in this country. They'll have to look at your credit score nowadays. Credit score, yeah. A bank statement, my own, I like that. It comes under the income. And of course, they have to look at the debt to equity ratio. What debts are you having? That's why somebody spoke of the pay slip, isn't it? If you are so much mortgaged already, these guys will not give you. Yes, you guys have very good points there. Great. Thank you so much. Ladies and gentlemen, I would want us to go to question number 4. Question number 4. Are we there? Question number 4. Are we there? You know, for mortgage, let me tell you something. For mortgage, ladies and gentlemen, normally the asset that is to be mortgaged becomes collateral. So long as that asset, you know, they'll have to do revaluations or other valuations themselves. So long as that asset is able to, they'll take that as, although they can also allow you to take in a secondary collateral, but in most cases that asset will be the collateral. So Winnie, they can't ask you for a logbook. Because I believe, Winnie, you're not going for a mortgage of $1 million shillings. You know, a mortgage will be something big, right? Samoy today will not see me. So can we go to question number 4? Question number 4A. Question number 4, if you are there, ladies and gentlemen, they wanted us to do something very simple in question number 4. In question number 4, they wanted us to do something very simple there. In relation to international debt instruments, explain the meaning of the term Eurobond. What are Eurobonds? Same year, Samoa, September 2021. September 2021, same year. Question number 4. So what is a Eurobond? A long-term debt, but you're missing on something very important there. It's an international long-term debt. It's an international long-term debt, which is denominated in foreign currency. Thank you very much. Which is denominated in foreign currency. Now, ukiulizwa euro notes, unatumia the same language, lakini inakuwa ni short-term debt. Euro notes. Je, ukiulizwa euro yen, utasema euro yen ni nini? Euro yen with Y-E-N. Euro yen. Yen now will be an international long-term debt, which is denominated in Japanese yens, isn't it? A loan in yens. Thank you very much. So what is the major, or rather what are the major advantages of Eurobond financing? Number two, they want us to give them. They want us to give them benefits of Eurobond financing. Why would you tell our finance minister to consider Eurobond financing? Go and borrow from outside there. Don't put too much pressure. Right? Increased liquidity, diversification, it's long term. Let me tell you the ones that I'll go for. They are given at concessional rates. Thank you, Shem. They're normally very cheap. You'll get in this case here, like a dollar, euro dollar, like the ones we take from America, then at about 4%. If it were not for our crazy unstable Kenya shilling against the dollar, we would really be paying very low amounts in terms of what your interests are like that, right? They're given at concessionary rates. Cheaper, I like that already. Flexible in terms of selecting currency, not really. The flexibility I would have wished you to speak about, Moreka, is the flexibility like when a country is not doing very well, when a company is not doing very well, it's quite easy to go and speak to these multinational lenders. They listen to you. Unlike our own here, these companies, these banks of ours here, they are quite quick to run, in this case here, to auctioneers. Thank you very much, Moses. Reduces crowding of domestic borrowing by government. Hence, it will lead to reduced interest rates. Great. Euro yen, tumesema nini uye? Euro yen tumesema it's an international long-term loan, which is denominated in terms of Japanese yens. Yani Kenya imeomba pesa kutoka Japan. Amuna point mzuri sana za advantages za Eurobond. Yeah, like access to higher amounts, I like that. I mean, you hear like right now, Uhuru Kenyatta is borrowing like the 8th tranche of 200 billion. That is some kind of money ambayo haiwezi kuwa unaweza kuomba hapa locally. Shida. Kama locally hapa, it can only be given to you by a syndicate of banks. All right. Ladies and gentlemen, people will always go for these Eurobonds because of what here? Most of those countries out there will not charge you taxes. The taxes quite there. The taxes are quite low or zero. Even some of the guys who will help you raise, this money is like the underwriters, these international underwriters, will charge you very little percentages, like 1%. Our own people, ladies and gentlemen, here are quite, they are quite bad. These guys here will charge you even 10% to get capital for you, right? People will go for these international currencies for purposes of stabilizing our own local currency here at home. So when these dollars come to the central bank, that is the easiest way of making your currency exchange rate to be what here, to be stable, I can see now Lucy thinking big. Lucy wants to go, and yes, they can be given to individual companies, but not you as an individual. Nobody can give you that kind of money. Thank you very much. Now, if you allow me, ladies and gentlemen, I'll take you straight away to question number 5. Question number 5 of the same sitting. Moses amefanya very good research. Anasema, if these Eurobonds are financed well, then automatically this will improve the credit rating of a country. Will improve the credit rating of a country. Are we in question number 5, my friend? Samabado. Are we in question number 5? Yes, sir. So question number 5, the number of hostile takeovers relative to friendly or uncontested takeovers is small. However, drama surrounds them, and they usually capture the interest of the press and the public. In light of the above statement, examine 4 legal measures that could be applied to counter mergers and acquisitions. How do you get to defend yourself against hostile takeovers? Yani, Lucy Alan, unapata mzee, wazazi wako wamemrecommend, wanasema Lucy lazima uolewe kesho. Wazazi wameangalia dowry. How do you defend yourself against these hostile takeovers? Ya kwanza ni shock repellent, isn't it? Shock repellent. Shock repellent, where you amend your articles of what here? Association. Where you amend your articles of association. Ya pili, ladies and gentlemen, is where you go to court, isn't it? Where you go to court. Where you go to court. On which basis? Competition. On the basis of competition. Yeah, you say that once you are acquired, ladies and gentlemen, once you are acquired, that this company that is acquiring you is going to become a monopoly. You know, we have what we call competition authority in Kenya here. That's number 2. Number three, the aggrieved shareholders can refuse to sign any transfer agreement of shares. Yeah. And then we have the last one, that the securities exchange. The securities exchange, the last one is securities exchange can be notified. In case of a company acquires 5% or more of the voting capital. Securities exchange should be notified if individual or a company acquires 5% or more of the voting capital. Ndio achunguzwe ametoa pesa wapi yeye. Hizo point mnasema zote, Robert ni mzuri. Lakini examiner alitaka kushika wanafunzi, akaweka jina gani? Akaweka jina legal. Hebu soma hapo mbele. In light of the above statement, examine 4 legal measures. So ukianza kusema white knight, whichever, itakuwa international what year disaster. Hapa ni legal measures. If, for example, we have amended our memorandum and articles of association, if that we can only, ladies and gentlemen, allow ourselves, see our company to be bought, if, for example, we sit down 90% of us. So if a few people sit down and then the company is acquired, we can take them to court. Right? Ladies and gentlemen, there is this clause which is in the Capital Markets Authority booklet, which says that anytime you have a single company or a single investor who acquires more than 5% or more of the shares of a company, it's important that we notify them. We notify the Exchange Commission, Nairobi Securities Exchange, right? Ladies and gentlemen, if that doesn't happen, we can go and sue later. How comes huyu jamaa atakwenda kusema, right? Nimechukua 50% of the, right? And then, of course, we have this concept of what? A competition authority, right? Shark repellent. This is the one where we put what we call the supermajority amendment clause. Mali Lucy anasema kwamba mimi niolewe, lazima nyanyangu akue kwa hiyo mkutano, akubali, sister zangu wote, kila mtu, paka ule last bwana kwa miaka 4. Lazima hawataikubali. So tukiweka hii shark repellent clause, ladies and gentlemen, we are basically putting down what we call the supermajority amendment clause. Supermajority amendment clause. So tunasema lazima tukutane kama 90% of us to approve Safaricom to be sold. Our shares yet, or not our shares, but the company to be sold. There's no way, that's an impossibility. There is no way you can ever, ni kama kukataa direct, yes. Hata ni direct actually. Ni direct. Mtu anakuambia kakijana, kajipatie shughuli, katafuta msichana mwingine. Very good. Question number 5B. Can we go to question number 5B? Kumbuka ni high level saa hizi. Ni high level. So can we go to question number 5, boy? Question number 5, boy. Yes. So nasema propose 4 types of financial synergies that could arise as a result of a merger. So as a result of a merger, how are we going to gain financial synergies? Give us examples of financial synergies which we may realize if 2 companies merge together. Number 1, of course, we have the concept of what here? Tax savings, isn't it? Tax savings, especially if one of the companies that is in the merger, ladies and gentlemen, has losses, right? Remember synergy, we are looking at 1 + 1 being equal to 3. 1 + 1 being equal to 3. Yeah, economies of scale because of what here? Production. Economies of scale because of production. I like that. That automatically will give you a financial synergy. It will increase your profitability. Yeah, cost reduction is a financial synergy. For instance, you will not be having 2 CEOs. This automatically will lead to some restructuring. I love that. Even this operational cost will have to go down, right? For example, because we'll be forced to share who? To share systems. All right. So, ladies and gentlemen, there we are. And risk diversification, yes. It's a portfolio basically you are forming. When you form a portfolio, there must be some financial synergies which come because of that, which come with it. Ladies and gentlemen, what I want you to do for me is a big favor. Nataka, mimi najua mnajua sana ya maneno. Nataka mnifanyie favor. Kuna ile swali limefanya sana kwa video ya breakpoint. Unakumbuka breakpoint? Unakumbuka breakpoint?